Hey everybody, this is Eric with Peak Financial Planning. I'm a certified financial planner professional. Today I'm going to be making a video about Silicon Valley Bank, the fallout of that. I'm going to try to do a four-part video here, short, to the point. My goal is not to provide ongoing coverage of this as a commentator. It's simply to provide actionable recommendations from a financial planning perspective of what you should take away from this news story, and also what can you do to protect yourself. So I'm going to cover what happened with Silicon Valley Bank for dummies. What does it mean for the average investor like you or I? What should you watch out for going forward, and what can you do to protect yourself? So understand. So contextually, you can think about what level of panic should I be feeling as I read and follow this story. Is it going to affect me, and how will it affect the country going forward? Okay, so let's back up. At the base level here, one thing to understand is Silicon Valley Bank made some big mistakes. There's a gentleman on Twitter named Macro Alf. He's a well-known economist, and I'll defer to his research and his writing, so I will link to that and show it on the screen in a second. But at the end of the day, it looks like this company had some C-level executives who kind of knew they were playing fast and loose with the rules and did not take the appropriate risk management steps or insurance for an outcome just like this that was predictable and known to be possible based on the fact that the Federal Reserve has been hiking interest rates. So what actually happened? Banks broadly fall into two categories. There's big banks and big smaller banks. The biggest banks are considered too big to fail. Those are banks that are over $250 billion in size. Those banks face a very, very tight, strict regulatory standards. The likelihood of something like this happening with one of the bigger banks is very, very low because of how tight the regulatory standards are. But banks that are under $250 billion in size face a looser regulatory system. And one of the quirks within that system requires them to hold a certain amount of cash and liquid investments on hand against a certain percentage of consumer deposits or deposits from you and me. And what they can do is that those liquid investments can actually be investments into things like bonds. And so Silicon Valley Bank specifically was around $220 billion in size. So they fell just under the cusp of this like too big to fail regulatory apparatus. And so they were allowed to use this accounting regime that allowed them to put money into investments that would then be used against deposits should there be a big influx of requests for consumers pulling their money from the bank. The problem here is that bonds do fluctuate in price. And so if a bank paid $1 for a bond, and 5 years later, that bond could be worth more or worth less. And what it is sensitive to, what determines the value of that bond is interest rates. When interest rates go up, bond values go down. So if the bank bought bonds in 2020, when interest rates were at 1%, and now interest rates are at 5%, that bond could be worth 50 cents on the dollar. And that's exactly what happened. So the events that transpired were there were too many requests for disbursements from the bank. The bank didn't have enough cash on hand, so it had to turn to selling some of these quote unquote liquid investments. But when it went to sell these liquid investments that on their balance sheet said they were all worth 100% of their original value, they couldn't find any buyers for it because nobody would buy it at 100% of the value because the interest rates had gone up so much that now these investments were worth fractions of their value. So the bank had to sell tons and tons more of these liquid investments, and it ended up that they didn't have enough in the value of these investments to cover the deposit requests that were being sent their way. Okay, so what happens next? The government gets involved, the FDIC goes and takes over the bank, and essentially what they're planning to do now is one of three options. We don't know which, so I don't have a crystal ball. Anybody who's on Twitter or the internet telling you they know exactly what's going to happen has no idea. We all are speculating, but there are really three broad things that could happen. One is the government could bail the bank out, just make everyone whole, provide all the money, and make everything right. Number two, they could try to sell the bank in one piece to another bigger bank. They could hope that JP Morgan would just buy Silicon Valley Bank and then make them whole. The third option is they could sell the bank piece by piece, different investments, different assets, piece by piece, which is a much more painful process. And in that case, they'd be selling at a discount, and who knows if we'd ever have the depositors being made totally whole. Okay, so why does this matter? Well, one, if the government bails this bank out, And it's pretty apparent. And again, I'll defer to these other individuals that you can find on the screen here. I'll show you. Macro Alpha has a thread here that talks about the exact risk management procedures that were taken at this bank because this was a public company. All their documents were made public. So you can actually read their 10Q and kind of figure out what's going on here. It looks like this was pretty criminal. The C-level executives had just sold a whole bunch of shares 2 days before the bank went belly up. So it appears that they knew that some of this was happening. It appears that they also were not paying for the proper insurance to kind of protect or mitigate from this type of event. So it looks like they were playing fast and loose. If the federal government bails out this bank, it creates what's called moral hazard, which is it basically teaches other banks and executives that they can get away with just this type of criminal or negligent behavior. And so it will reinforce that that can be done. And we will see this happen again in the future. It's a huge problem. So one, I'm not a fan of a bailout here. The second option, where they sell the whole bank as one bigger piece, that's probably the best option. The question is, will any other bank want to buy a failing bank? Who knows? Maybe with some strong arming from the government and some muscle, that will be the case. The third is, if they sell it in pieces, it's likely that depositors will not be made fully whole. What happens if that's the case? Probably the most likely outcome is that third one. In some way, it could take, and even if that third one is somewhere between option 2 and option 3, it's very likely that this process takes a long time. If you had $250,000 or less as an individual in an account at Silicon Valley Bank, you will be made whole because you have FDIC insurance. That's the Federal Deposit Insurance Corporation. And their insurance limit is $250,000. And pretty quickly, you will be made whole. And you can choose to take your money to a different institution, whatever you want to do. If you had more than $250,000, the question is, how long does it take you to get those funds? And the real problem arises in the fact that most of this Silicon Valley Bank's clients were big businesses. They were venture capital based, not profitable tech companies who really, really need access to those funds on a daily and weekly basis. Because if you have a company with 1,000 employees and you're not profitable, you actually need to pay your employees out of the savings from that bank account because that's how you're funding your business. And all of a sudden, if you cannot access those funds, how do you keep the business operating? So that's a question that remains to get clarity this coming week, where we'll start to see, like, will the funds be made? Like, will these businesses that are not profitable just suddenly have to go out of business because they don't have access to funds? Will there be mass layoffs? Who knows? But we'll find that out pretty quickly this coming week. How does this affect the average person like you and I? Well, one, you should start to understand and learn what FDIC insurance deposit limits are, how you manage that, and what SIPC insurance deposit limits are, because that is another tool. There are some financial planning tools in the toolbox that you can make use of that will help you manage this. We'll talk about those in a second. The second thing you should take away is that there's a lesson to be learned here, which is when we are rewarded for taking too much risk without any possibility of consequence, because it appears that the CEO and the different C-level people at this company believed that they would get a bailout and did not think there would be real consequences for these actions. Like it appears that they had no idea that this would ever happen. Because how could you be so negligent and careless if you thought that there was actually possibility that this whole thing would blow up? This kind of environment is created when we are no longer told as a society that there are consequences for our actions. So the important takeaway here is to understand that there's always trade-offs. Everything we do has trade-offs, especially when it comes to finances, because you don't really get do-overs. The idea that life is about trade-offs also extends to your portfolio and your own retirement planning efforts. Life is about trade-offs. There is no reward without taking on a certain amount of risk. And so in that regard, being attentive to managing risk is oftentimes much more important than only seeking out the highest rate of return. Okay, we'll come back to that. So now let's talk about FDIC and SIPC insurance. What can you and should you do? Well, if you have money in the bank or you're near retirement or you're just nervous about this, here's a quick lesson on the two different insurance types and a planning option you can do to protect your assets, your cash assets. FDIC insurance limit is $250,000 per individual per institution. What that means is if I, Eric, have $250,000 at Wells Fargo, that money is all Federal Deposit Insurance Corporation insured. Let's say I have $500,000 at Wells Fargo. Only $250,000 of that is insured if that account is in my name only. If my wife is also on that account, then that full $500,000 is insured because I have $250,000 insured and she has $250,000 insured. Now, let's say I have more than $500,000. I should open another account at another institution because I get $250,000 of insurance per institution. So if I have $250,000 at Wells Fargo, and I have 250,000 at Chase. Both are fully FDIC insured. On top of that, let's say I have more than that. You also can benefit from what's called SIPC insurance. SIPC insurance is brokerage account insurance. It's exactly the same as FDIC insurance, but it functions for brokerage accounts. That would be your IRA or your Schwab brokerage account. Those companies also, the investment accounts, also have this similar type of insurance. Actually, it has a higher insured amount. And SIPC insurance is up to $500,000 per account, or sorry, per individual, per institution. $200,000 of that $500,000 can be cash, and then the balance can be investments, or the entire $500,000 can be investments. But you can still have cash in a brokerage account that is insured. So if you have a lot more cash and you're looking for ways to spread it out and manage it, you can make use of spreading it out between FDIC insured accounts as well as SIPC insured accounts. That's a strategy you should probably speak to a financial planner about, because obviously one of the trade-offs that happens as well is the more accounts you have, the more complex your situation becomes to manage. And so we always have to balance out and weigh out this complexity versus security. There's a trade-off there as well. Now, that is a financial planning action that I recommend you consider and take. Again, you can speak to someone or you can do it yourself, but that's something that you can control. And so you should do it. Separate from that, how will this affect clients and market outlooks and investments? Well, that is a much more complicated subject as well, but clearly you can see that the market is down. All of us don't know exactly how this one folds. Is this isolated to one bank? Is this systemic, meaning will it spread to other banks where they had deposits or loans with Silicon Valley Bank and now all of a sudden they're going to be under pressure and potentially facing a bank run? We don't know. We're going to find out over the coming days. And so we will adapt an investment strategy accordingly. But one thing I always recommend to clients is, and this is yet another confirmation of this lesson, is playing defense and paying attention to defense is so important. We've just completely lost sight of that in the investing landscape. It's all about offense. Get the highest rate of return. Put things in the highest, put things in Bitcoin. Put things in an S&P 500 index fund at any age, at any time. It's always cheaper. It's always better. And that's not true. Life is complex. Everyone's plan should be individualized. And this is a reminder of that, because this is an example of a story gone wrong where they were chasing too much reward, taking on too much risk without any care or attention paid to the potential consequences. And that's just a reminder for all of us that when you get greedy, you get burned. It's just a matter of when. And the question is, can you take that risk, and should you take that risk? It's not for me to tell you. Now, I hope you enjoyed this video. If you have comments or questions, you can put them below and I'll answer them if you'd like me to address other subjects. Just a reminder, my intention is not to be commenting on this day to day. I will make a video if this extends to influencing clients' retirement plans or investment outlooks. I will comment on that so we can kind of stay informed as a community. But other than that, if you'd like more information about the work I do with clients, you can find me at thepeakfp.com or Google Peak Financial Planning. Also, one thing that I recommend is I have a webinar. It's called The Secret Retirement Plan Big Finance Doesn't Want You to Know About. And this is actually a really opportune time to watch that, because what's going on with Silicon Valley Bank is exactly an example of how big finance doesn't play by the rules. They play fast and loose. And then the cronyism between the government. And there's a whole kind of apparatus around big finance that wants you, the individual, to feel dumb and less powerful and less influential about your own outcomes and defer your decisions and your power to them. And then they go and take huge risky bets with it and it burns you. So this webinar I do is all about the 8 key behaviors you can directly take that have nothing to do with your financial provider that can influence your outcomes, your financial independence, your financial freedom, and your retirement plan in extremely powerful ways. So I highly recommend you watch it. That is the core of what I do with clients. And it does also extend to investments, but the idea is investments should be the last part. That should be the last step you tackle. You should do everything that's in your power first so that you ensure, INSURE, ensure your investment performance, rather than hoping that your investment performance will make your retirement or your financial independence possible while you abandon and avoid all the other behaviors that you can control. So I hope you enjoyed this video. Again, it's a call to action in my opinion, and post any comments or suggestions below. And I thank you for your time and attention.